Hey investor friends, I'm Michelle Markey, and let me ask you a question. Do you feel like the United States is already in a recession? Let me know what you think in the comments, because based on some measures, the US may already be in a recession, like how US gross domestic product, or GDP, has already had 2 consecutive quarters of decline in the first and second quarters this year. And also with the stock market being well into bear market territory, it's kind of just felt like there's been a lot of economic gloom and doom so far. And according to some big business leaders like Jeff Bezos of Amazon and Jamie Dimon of JP Morgan Chase, they suggest that a recession could still be on the horizon. So I'll reflect on what they've said and what I think is happening. And if you also appreciate being financially prepared, no matter what economic storm could be on the horizon, please be sure to like and subscribe to my video and YouTube channel, because it greatly helps with the YouTube algorithm. And I really hope that what I'm sharing with you today will help you in your financial journey. So thanks. Recently, it seems like America's business leaders are turning increasingly cautious, because when Goldman Sachs' CEO David Solomon said that there is a good chance of a recession, Jeff Bezos reacted by tweeting, "Yep, the probabilities in this economy tell you to batten down the hatches." And this seems to echo what Jamie Dimon was saying back in June, when he believed that an economic hurricane is on the horizon, and he said to brace yourselves. And recently this October, he also said that the US is likely to tip into a recession in 6 to 9 months, which means that the US could have an official recession maybe by April to July 2023. And this also follows similarly to what I've predicted in the past based on what other economists talked about. Like, I talked about this in early 2021 about how 2023 seems ripe for a recession. And while I haven't heard Jeff Bezos share more thoughts about an impending recession, maybe one sign of how Amazon is battening down the hatches is revealed by how they're freezing corporate hiring. And we'll have to see if more comes out of Amazon's activity and how they're preparing for what could be coming. But Jamie Dimon has been way more vocal about some of the signs, like how we still have really high inflation and interest rates are going up more than we expected. And also we haven't seen quantitative tightening quite like this on the scale. So we don't know what the effects of that will all be. And we're also dealing with the ongoing effects of the continuing Russia-Ukraine war. And also this year, unlike 2021, we've barely seen much initial public offerings or IPOs where startups are going public in the stock market. And so that's a sign that a lot of business activity is paring back. And also we're seeing less high yield debt or bonds being released. So maybe that's also another sign that people are not as aggressively growing as they used to do when they had access to cheap debt. And he also said that more bridge loans are being hung, which means that less short-term debt is being issued to secure permanent financing. So among some of these signs from this well-respected banker, I think that this is something we should be listening to and heeding about what he's expecting, because he's been really vocal throughout this year about bracing ourselves. So I think that winter is more than coming. And to shed some light on what Jamie's talking about when he says that interest rates are going up higher than they expected, and also we haven't quite seen quantitative tightening on a scale like this before, what he's talking about is how the Federal Reserve has to increase the Fed funds rate in order to try to fight high inflation, because we're dealing with some of the highest inflation in 40 years, where the consumer price index or CPI inflation was at 8.2% in September, which is way above the average 2 to 3% that we normally have. And so based on that fact, the Federal Reserve is hiking the Fed funds rate aggressively, and the Fed funds rate dictates the interest rates that banks lend to each other in overnight lending. And the Fed funds rate also dictates a bunch of other rates like mortgage rates or loans that people might get. And so whatever the Fed funds rate, usually you'll see loans or mortgage rates at about 3% above that rate. And right now we currently have a Fed funds rate of between 3 to 3.25%. So it's no wonder that mortgage rates are north of 6%. So can you imagine the higher that the Fed funds rate goes, the more pain we'll see for people trying to get mortgages and trying to buy homes, because that means their mortgage payments are going to be more expensive since they have to pay even more interest. And so because people weren't expecting the Federal Reserve to really be as aggressive as they are with hiking interest rates, that's causing the stock market and a bunch of other things to dampen in their activity. So it also makes sense that the stock market has been generally declining after a little increase, like a rally in the summer. They didn't think that the Fed was being really serious about hiking interest rates. So before, a lot of economists were projecting that the Fed funds rate might only go to around 4%. But people are taking the Fed a lot more seriously now in their commitment to fight inflation by aggressively hiking interest rates. So much so that the CME Group's Fed Watch tool is projecting for the Fed's next November meeting that they're going to increase rates from the current range of 3 to 3.25% by another 75 basis points, all the way up to 3.75 to 4%, which is a huge jump and basically the previous limit that economists were expecting before. But now that they are seeing the harsh reality of things, they think that the Fed is going to continue hiking interest rates by another 50 basis points at the next Fed meeting in December, that it will be by that time at 4.25 to 4.5%. And also there's a little bit of a break, but by February 2023's meeting, the Fed will also hike by another 50 basis points to 4.75 to 5%, which, can you imagine mortgage rates then going up as high as 8 or 9%? Like, that's a lot. So a lot of people could be priced out of the housing market just based on mortgage rates alone, because it means that their mortgage payments and interest payments will balloon to way higher amounts. As bad as they are now, it's probably going to be way worse when the Fed hikes to as high as a 5% Fed funds rate. But it could be good for those of us who like to save our money, and then most likely, hopefully, our bank accounts will also give us interest north of 4%, maybe as high as even 5% if we're so lucky. But I doubt that our bond rates are going to be that much higher. Like, since inflation is starting to come down, I don't think the future Series I bond rates are going to be as good as they were currently as of October 2022. So also brace yourselves for that. Notice the theme here of bracing ourselves for upcoming economic travails and turmoil. But anyway, also, this Fed Watch tool is projecting that the Fed will eventually have to bring down rates, but they're not going to do that until maybe December of next year in 2023. And by that point in time, maybe they'll only bring it down by 25 basis points to maybe the range of 4.5 to 4.75%. So as you can see, a lot of people now believe that the Fed is committed to bringing down inflation, even if it means that the economy is going into a recession and that the stock market will go down even more. Because that's another thing that Jamie Dimon predicts, is that the stock market could easily go down by another 20%. At the time he said this, the stock market was already down, if we look at the S&P 500, by about 27.5%. So another 20% on top of that could be around 48% that the stock market could go down as far as, or maybe around more than 50%. So imagine the S&P 500 getting cut in half from its all-time high of 4,800 in January this year down to maybe 2,400. So I think that that's way more possible than maybe a lot of people believe. And I think we should prepare in case that becomes an economic reality for all of us to maybe deal with losing jobs, or also our stock market portfolios also being really down. But where there's a lot of chaos in financial markets, there could also be a lot of opportunity. So I actually see this as a good thing for us to maybe buy stocks. And so if you see it that way, instead of focusing on how your portfolio could be in the red, see it as a chance to buy all of your favorite company stocks on sale, where maybe even though they're down now by 25 to 30%, imagine that their stock prices could be down by as much as 50 or 60%. And I think that if you believe in these companies for the long term, like for at least 10 years, that it will be an especially good buying opportunity if they're down by that much in the spring or summer of next year. And as much as some of us might feel like eager beavers, myself included, and maybe wanting to buy more stocks whose market prices have come down a lot, making their valuations more attractive than they had been, we might want to curb our enthusiasm, because there's one more sign I want to tell you about, known as the Buffett indicator, and it's based on the Wilshire 5000 total market cap over US GDP. And this measure is a reflection of the overall market's priciness. And it used to be super high, like back in the third and fourth quarter of 2021, it had reached 250% of market value to GDP, which was super expensive because, according to Warren Buffett, he believes that the market's fully priced when this measure is at about 100 to 120%. And it was more than double that amount back last year. And it's come down starting in the first quarter, where it went to 234%. And then in the second quarter, it went to 209%. So it's still double what Buffett considers a fully priced stock market. And based on currentmarketvaluation.com, the Buffett indicator on there suggests that the current amount is at about 150% as of October, but it could go down even more. So what this is suggesting is that the market is still really fairly priced, and maybe if we expect to get even better deals, we should wait until the market goes down to below 100% on this Buffett indicator, because that's when Buffett believes the market is more on sale. And he definitely went ham in buying stocks during the great financial crisis. The last time that this Buffett indicator went below 100%, like it was around 80%. So we still have halfway to go if we think about it to getting to that level again. If you want to have this as a sort of ballpark rule of thumb, it's not necessarily to say that you shouldn't buy stocks, but maybe just mentally be prepared in case the stock market goes down that low. And so based on everything that I've told you, what do you think? Do you think there's merit to what Jamie Dimon and Jeff Bezos are talking about? Or is there any merit to some of the signs that I've talked about today? Let me know in the comments. I would really love to hear from you. And if you enjoyed this video or learned something, please like and subscribe. And I wish you well on your journey to investing the best way you can, no matter what happens in the stock market or in the economy. Till next time.